Hey Matt, so I'm really surprised. Like we were talking about some loan options and mortgage rates for a client of mine. You mentioned that one of your clients just got a 2.9, was it 2.99%?
2.99% rate in
Wow.
2023. I know it's unbelievable, and people are going to think that I'm out of my mind or I'm lying to them. They have a 2.99 for the first year. And this specific loan, I'll tell the quick story on it because it's a fun one for me. Investor looking to buy a duplex. Seller had a price in mind that they wanted. There was some flexibility in that where they could structure the deal where they paid 1.17 million for the duplex, got $70,000 in credit. This $70,000 allowed them to do a 3-2-1 buy down. We'll talk more about the buy down and buy down options later, but for this specific scenario, what the 3-2-1 buy down does is gives them 2.99% interest rate in year one, 3.99 in year two, 4.99 in year three, and then 5.99 for years 4 through 30. It's not an adjustable rate mortgage. It will never go above 5.99 if they don't ever refinance it. But for this specific buyer, and every buyer is different, it allows them to save, I'm looking at it, $2,000 a month between their 2.99 and their 5.99 in year one. That allows them to cash flow, stabilize this duplex, have money in their pocket for repairs and anything that they want to do, right? Any vacancies they might experience while they're getting this thing rented and whatnot. And so really, really great product, but it's one of those things where everybody wants something different. In this case, $50,000 of that $70,000 credit funded the buy down. The other $20,000 helped offset some costs. So you talk about a low capital investment. They're all in on this $1.17 million purchase for about $53,000 because they put 3.5% down on an FHA deal, got the credit not only to do the buy down, but another 20,000 ish to offset closing costs. And so this is one of dozens of examples just in the last quarter or two of the power of the temporary buy down.
Okay, wow. So I'm thinking there are two opportunities for folks here in the South Bay and Beach cities. If they're looking to buy a home, then definitely this buy down seems like a way to really cut costs on their initial mortgage rate. And for sellers who have a property, because things have slowed down in some cases and certainly in some neighborhoods, who are stuck and the home is not moving. If the real estate agent is not on top of this type of idea, I think that's a problem. This sounds like a fundamental opportunity to really make a listing stand out. And
yeah, I agree 100%. I didn't mean to cut you off, but it's such a popular product and it makes so much sense to both buyers and sellers that I'm starting to see it on listings in the MLS. I've got agents coming to me and saying, you know what? They actually lists in the MLS that $900,000 purchase price, they're offering up to $15,000 for a buy down. And the thing about it is if you're a seller and you're offering that, you're putting the buyer in a much better mortgage at $900 with $15,000 in credits towards a buy down than you would be if you just said, hey, we could agree at $885 purchase price. And so buyers like it because it's a way to structure a mortgage that makes more sense for them. Sellers, if you net 885, you shouldn't matter how it happens, whether it's 885 straight, 900 with 15K in credit. And so it's truly a win-win, which is why it's so popular. And, 1.0 buy down, 1.1 buy down, 2.1 buy down, all these different products, it's going to be different for different people. But to your point, owner occupied, you're buying the house to live in, you might be taking on a mortgage payment that is a little bit higher than you wanted or a little bit higher than you expected. By doing the buy down, you just get to ease into it, right? And I think that the couple things that I like about it for my clients is, one, you can ease into it and you know that there's a cap. It's never going to go above that rate on a 1.0. It's a discounted rate in year one, and then years 2 through 30, it never goes above that. So it's not an adjustable rate. Hopefully people will get that loud and clear, not adjustable rate. The second thing that I think is really cool, say you get 20,000 in credit to do a 2-1 buy down. And for, today's rates, let's call it 499, 599, and 699.
Mm-hmm.
If we see something happen next year with inflation, with it being an election year, whatever outside factors, none of us are crystal ball, rate prediction masters.
Mm-hmm.
But let's say rates go down to 5.5. If you refinanced out of this before that 2-year period, you would get a refund of whatever's left over in that buy down account. It goes towards a principal reduction. So the money doesn't disappear. In a permanent buy down situation and other situations, it's a sunk cost and it's gone. This is actually sitting in an escrow account. It's funding this discount in your mortgage payment over the first year, first 2 years, however you structure it. And it's refundable to you if you refinance before it's all been used.
Okay, interesting. So do you have any examples? Because I know that by now, I think that some of our viewers will probably want to look at the math. They want to see, well, what does the payment look like?
Yeah, I'll give you an example. And this might be one for, a luxury buyer, at least where I'm at. This is a luxury buyer. And maybe it's a home that hasn't, sat on the market for 45 days. Maybe you can't get 20, 30,000 in credit, but maybe you can get 12. And in this case, I think the buy down was somewhere in the neighborhood of $11 or $12,000 needed to fund it. But the buyer is buying at one point. You know what I'm going to do? I'm going to change these numbers because 1.8 might feel crazy to some people. Let's make it 1.5.
Okay.
And so 1.5 with 20% down, I can share this with you and we could put it up, but maybe 1.5, about 10 or 11,000 in credit needed, I think, for this. But rather than go straight into your 6.875 30-year fixed and have a payment of 10,100 from the start, you'll get a reduced rate of 5.875 for the first year. And so a 93.23 payment, rough math, $800 a month savings in year one. And, for a number of reasons, it makes sense for a buyer, because if you pay 1.5 or 1.488, right? It doesn't matter to you much as a buyer, but $800 a month in year one is helping with cash flow. Maybe you're 10 months off from paying off your car. Maybe you're, trying to put your kid through their last year of college, whatever the case may be. This is something that it's something that makes sense for people. And what I will say, Steve, is at the very least, it's an option.
Right.
I've shown this to some people just to say, hey, here's one option. Let me know if it's not. And some people say, you know what? I prefer to, spend a little money for a permanent buy down, just set it and forget it. And none of this fancy temporary buy down stuff. Okay, cool. Others, for whatever reason, I'd rather pay $15,000 less. Okay. But in a market where we all know affordability is important, this is just one little way to, structure a mortgage that makes sense for a buyer. And to your point, sellers as well should be aware of this because it's a way for them, if they've got a property that's not selling and they realize they haven't seen the headline that we're at a 27-year low for mortgage demand, right? People aren't breaking down their door to come make an offer. Offer something like this that allows the buyer some relief from a market where affordability is an issue.
Right. And what I've been hearing in the news and also from many home buyers that I've been talking to is they're really waiting for 5.5, 5.75 is sort of the magic number to start freeing things up. And because most sellers are going to be buyers, they're also concerned about that. They may have a 3% or 4% mortgage that they refinanced some years ago, and they don't want to suddenly turn around and get into a 7%. So it sounds like we have a way of structuring the deal on the sale of their home, which is going to get it sold faster and potentially for more money, and then ease them into the purchase of their next home, where they get that interest rate that they're really looking for the first, it could be 1, 2, 3 years. And, you know, from what I'm hearing, and I just did a video on this on the rate forecast, that the consensus seems to be that we're going to be in the 5s again in the next, you know, 2 or 3 years. So that opportunity to just refinance and make it permanent.
Right. I agree. And the thing about the current market with less, you know, buyer activity and less buyer demand, as a buyer, you can go out there and get yourself a great deal, knowing that you can always refinance to a lower rate if it becomes available. If it doesn't, I promise you, no bank calls you on your 6.875 30-year fixed and says, you know what, rates are higher and we're thinking we want to get 8.5% from you now. So let's refinance you higher. That doesn't happen, right? And that's, I made a video earlier today. Warren Buffett loves the 30-year fixed rate mortgage because of that, because of the fact that it's fixed, you know what it is, and you can only negotiate it better. You're not going to negotiate it worse. So I think that's a good place to end it, Steve. If somebody wanted to get a hold of you and I was thinking about buying something in your neck of the woods, how would you like them to get a hold of you?
Well, contact information is coming up right here. So you can call me, you can text me, send me an email, and you know, I'll get you set up with the home search. And of course, we can run through some of these scenarios with you and get them pre-qualified, look at some of these costs potentially for doing the buy down and how that would all look. And we'll go out and find a home where it's gonna be a good fit.
Sounds good. Yeah. If it's not me, make sure it's a great broker that's able to give you these options. If you want to connect me and my team, go to greatmortgagebroker.com. Thanks for talking to me, Steve. I appreciate it.
All right. Thank you.